we get to the Q&A section. And feel free to drop questions in the chat throughout. And then if they're really pertinent or time pressing, we'll answer those right away. If not, we'll cover them all at the end, but kind of here we go. And so today's topic is carbon reporting. And so what are we trying to accomplish today? And so we want to cover what is carbon reporting? How do you report carbon? Why is carbon reporting important? Why do companies report? And then what to do after reporting. So that's the overall agenda for today. And hopefully by the end of this, you have a better understanding of carbon reporting. That's the goal. So again, starting off with the key question of what is carbon reporting? I want to start with some fundamentals here of what carbon reporting is and what carbon reporting is not, kind of set a baseline for everybody for understanding. And so carbon reporting, these are corporate level greenhouse gas emissions. These are not product level emissions. Those product level emissions will show up in a later module covered when we cover life cycle assessment and environmental product declarations, EPDs, et cetera. And so the main focus of today is corporate level GHG emissions. Carbon reporting, it's also referred to, it's got a few different names. It can be referred to as carbon accounting, greenhouse gas accounting, GHG accounting, GHG reporting, or conducting a GHG inventory. Basically, this is marketing. It's much easier to say carbon reporting, and carbon is easier to understand for most people than greenhouse gases, to where then you have to explain what a greenhouse gas is, which we'll do today. But for the everyday person, carbon reporting is kind of one of the common names that we see. And then carbon reporting is also a way to measure, manage, and disclose greenhouse gas emissions. Carbon reporting is not just about carbon. There are other greenhouse gas emissions that are accounted for through the protocols, standards, and we'll cover those today. And then carbon reporting is not a substitute for a company's entire sustainability program. This is one component of it. There's a good graphic that gets shown, or a theme that gets thrown around, called carbon tunnel vision, where carbon is the thing that shows up in news cycles more often than not. However, there is a much broader scope to a sustainability program for a company, and carbon accounting, greenhouse gas accounting is just one component of that. So again, some more fundamentals here. This is something that if you attended or watched the module that Josie presented on, she talked about greenhouse gases and the difference between them. Just wanted to cover our bases on this. Again, there are 7 greenhouse gases that have been identified as need to be tracked and accounted for under the Kyoto Protocol from 1992. And those are carbon dioxide, methane, nitrous oxide, some fluorocarbons, HFCs and PFCs, sulfur hexafluoride, and nitrogen trifluoride. And so some of these greenhouse gases actually occur naturally and are also released by human activity, things like carbon dioxide, methane, and nitrous oxide, where other ones are synthetic and have long lifetimes, things like HFCs, PFCs, sulfur hexafluoride, and nitrogen trifluoride. But this is to just give you that baseline to say these are the greenhouse gas emissions and the gases that need to be accounted for when considering carbon accounting and reporting. Another thing that Josie covered, but want to go a little bit further in depth on, is global warming potentials. Not all greenhouse gases have the same impact on the environment and the planet. Global warming potential is determined by a greenhouse gas lifetime in the atmosphere relative to carbon dioxide. And so when you see on a lot of reports and a lot of summaries, you'll see carbon dioxide equivalents, CO2e, and that is how greenhouse gases are reported and rolled up into a final number. And then finally, GWPs are updated every few years by the IPCC, or Intergovernmental Panel on Climate Change. And then in the table on the right, you can see a few of the different global warming potential factors for the different greenhouse gases. And so carbon dioxide, again, that's the baseline, that's one, and then it goes up from there. So methane is almost 30 times more potent than carbon dioxide. That also hits the news cycle a lot. And then when you shift down to those synthetic gases, those fluorinated gases, and then sulfur hexafluoride and nitrogen trifluoride, you get into the tens of thousands in terms of GWP. So they are highly, highly impactful. And that's why the reporting standards, methodologies have created the global warming potential to back that all in so we can all talk the same language about carbon dioxide equivalents. But this is a key distinction that there are different greenhouse gases that need to be accounted for. Fantastic. An old saying, or a quote from Maya Angelou that I love is, if you don't know where you came from, you don't know where you're going. So I wanted to give a little bit of history on two big standards that have been developed for greenhouse gas accounting and reporting. The first being the Greenhouse Gas Protocol. And so the first initiative was convened in 1998, and the first standard, the corporate standard, came out in 2001. The current version, which was revised for the corporate standard, was released in 2004. So it's been over 20 years since we've seen a revision on that corporate standard. And then coming up through 2023, there've been different standards or appendices kind of created, some very significant ones. In 2011 were the corporate value chain scope 3 accounting and reporting standard, and we'll get into the different scopes, scope 1, 2, and 3 in much greater depth in coming slides. Scope 2 came out in 2015, and then a little shout out to WAP on this one. We actually helped write a sector supplement for measuring and accounting for embodied emissions in the built environment that you can see here, that came out in 2022. You might be saying that this is old. Like, how can we be going on a standard from 2004? There's been a lot of changes in the world and in the sustainability world, specifically in that time frame. There are active working groups focused on updating each of these standards, and with a plan to release draft updates for public comment this year. And so this is, again, kind of how we got to where we are today. But there are active groups working to update these standards. The next big one, there are others, but these are the kind of the two major ones that most companies use. The other one is the ISO 1464 from the International Organization for Standardization. So ISO 1464 is a 3-part standard for measuring and accounting for greenhouse gas activities. This standard was launched in 2006. And then, as you can see here, the 3 different parts. So the ISO 1464-1, the most recent version coming out in 2018, is guidance at an organizational level for accounting for greenhouse gases and removals. ISO 1464-2, revised in 2019, is project level guidance, again, for quantifying, measuring, monitoring greenhouse gas emissions. And then ISO 1464-3, also revised in 2019, is guidance for the verification and validation of greenhouse gas statements. So all of these come together to form ISO 1464, with the first one being how to do the accounting at an organizational level, the second being at a project level, and the third being very important, and it's the verification and validation of greenhouse gas statements. Again, as more and more regulations come out, which we'll also discuss on later slides, verification is becoming hugely important. And so having these standards to fall back on and look at and understand how to accomplish that is crucial. Fantastic. So now, what emissions am I supposed to account for? We need to talk about boundaries. So there are 2 different types of boundaries. There's organizational boundaries and operational boundaries. Organizational boundaries defines the extent of an organization's greenhouse gas emissions responsibility and encompasses all the activities, operations of an entity, and how they're supposed to account, the boundary at which they are supposed to account for their emissions. There are two distinct approaches. There's the equity share and then the control approaches. And then within the control approaches, there are two different control approaches, being financial and operational. Equity share is, as the name suggests, where an organization accounts for emissions associated with their share of equity in an operation. Financial control is where an organization accounts for 100% of the greenhouse gas emissions over which it has financial control over those operations. And then there's operational control, which is very similar, that you account for 100% of the emissions for which you have, as the name suggests again, operational control. Most companies use the operational control approach. However, the equity share and financial control boundaries are more commonly used by companies with diverse and complex control structures. It gives them more flexibility in defining their boundaries and accounting for these greenhouse gas emissions. And so before you ever start going down the path of accounting, you have to define these boundaries because that will dictate what needs to be accounted for. The other type of boundary we need to talk about, and we'll spend a lot more time on this, is the operational boundary. And this boundary involves identifying emissions associated with operations. So this is where we get into, if you've heard the term scope 1, 2, and 3, this is the emissions, and you're defining which of these categories that need to be accounted for. Don't worry about focusing too hard on this image. I blow it up more in the next slide. But this is produced by the Greenhouse Gas Protocol and is widely used for visually displaying the types of emissions that occur. Fantastic. As promised, much bigger picture on this one, and diving a little deeper into operational boundaries. So scope 1, scope 2, and scope 3. We'll start with scope 1 and 2. Those are a little easier to understand. Scope 1 are owned and operated facilities and fleet, the emissions coming from that. So think of fuel in vehicles or natural gas being consumed on site. And then scope 2 is purchased electricity, heat, and steam for your facilities. And so those are under your direct operational control. You get to turn on a light switch, start an engine, start a boiler, start a generator, etc. And so those are defined as you having full operational control over. And then the much larger emission sources come from scope 3, and those are your value chain emissions. And these result from activities that are controlled by you, not controlled by you, apologies, but that indirectly affect your value chain. So things like purchase goods and services, the things you're buying, transportation and distribution, how your goods are getting to you and or how your products are transported to your clients. We'll go much deeper into scope 3. There are 15 different categories. And for most companies, scope 3 emissions account for 80 to 90% of total emissions. So this is scope 3. That's why it's talked about so much, is because so much of global emissions are associated with scope 3. Okay, so before we dive into all of the different scopes, I felt it was necessary to talk about these 5 key principles in greenhouse gas accounting. These show up in both the Greenhouse Gas Protocol and the ISO standard, and they are relevance, completeness, consistency, transparency, and accuracy. All of this is basically saying that when you are accounting for something, your emissions, that you need to follow these principles to do so correctly. So relevance talks about collecting data that is pertinent or relevant to your organization's activities and goals. need to cover all aspects of your operations. Completeness requires organizations to account for all relevant emission sources and sinks within their operational boundaries, so not leaving anything out. Consistency, this is a big one, emphasizes using and maintaining the same practices in data collection, calculation, methodologies, and reporting formats over time so that you can create that baseline and then track your progress over time. If you shift between data collection or calculation methodologies, there can be significant shifts in your emissions, and it makes strategic planning internally much more difficult. Transparency is a big one in all of sustainability. It's being open, as the name suggests, transparency in disclosing the methodologies used, the assumptions used, the data sources used, any uncertainties through the calculations, providing readers or stakeholders with a clear understanding of the reported carbon footprint. And then accuracy, again, this one kind of speaks to itself, is being as accurate as possible, using measurement methodologies, reliable data sources, appropriate emission factors to ensure that the reporting of your greenhouse gas emissions is accurate and as error-free as possible. So again, these show up in all carbon accounting, but are key principles that sometimes get overlooked. So now for the fun part, really getting into the weeds on scope 1, 2, and 3. So the easiest way to think of scope 1 emissions are things that fume. So they're broken into a few different categories of stationary combustion. So equipment such as boilers, furnaces, generators, things that don't move but consume fuel and therefore produce emissions. Mobile combustion in vehicles, this cars, trucks, forklifts, etc. Again, fuel is being consumed to operate these and emissions are related. There are two others that show up. There are process emissions, which are emissions from the physical or chemical processes, such as carbon dioxide from the calcination step in cement manufacturing. These are highly industry specific, whereas stationary and mobile combustion are pretty industry agnostic. And so if you are in an industry that has some of these process emissions, it is very important to account for them and understand what's happening. But for a vast majority of companies, they don't necessarily show up. And the last one is fugitive emissions, is the intentional or unintentional release of greenhouse gases from equipment. A common one for most companies would be HVAC systems. This could come from leaks in joint seals, gaskets, etc. Also wastewater treatment, cooling towers, gas processing facilities. There are emissions and gases released that again are sometimes intentional, most of the time unintentional. And so those are accounted for in scope 1 as well. So again, things that fume is the most important part of scope 1 considerations. Diving into scope 2, the most common source of scope 2 emissions is from purchased electricity. However, there are a few other sources of emissions that are included in scope 2, including heat and steam. And so this is purchased heat and steam. So something that is produced offsite that is pumped on site. But really scope 2 is more about electricity. And getting into the big ones, scope 3. So scope 3 is designed to account for emissions from a company's value chain. Again, there are 15 scope 3 emission categories. There are 8 upstream categories and 7 downstream categories. Upstream includes purchased goods and services. So think of the things you buy, whether it's raw materials or snacks and coffee or office supplies, all of that falls under purchased goods and services. We're going to dive into that one a little deeper, but as Josie presented in her presentation, this is really thinking about embodied carbon. And so the carbon that is captured from the production of a product. The next one, capital goods, very similar to purchase goods and services, but it's the products that you capitalize. So heavy machinery, industrial plants, anything that is capitalized on a company's books falls under capital goods. And again, thinking embodied carbon. The next is fuel and energy related activities. And so when you think of scope 1 and 2 is where you think of fuel and energy, but that is from those emissions are capturing the moment that is combusted. So the moment you turn a light switch on or the moment you turn an engine on, those are your scope 1 and 2 emissions. This category captures the emissions associated with producing those fuel and energy sources upstream. Next is transportation distribution. There's both an upstream and a downstream transportation distribution. And as the name suggests, this is the movement of goods. And so if you're using a third-party logistics company, or how your goods are getting to you and or going out to your clients, that's what is captured in transportation distribution. Waste generated in operations, it's simply, as the name suggests, is waste, and there are emissions associated with the waste that are generated. The next is business travel, and this encompasses everything from commercial air to rental cars. Hotels can fall under this category, trains, lifts, Ubers, ride shares. So all of those emissions are accounted for under scope 3 business travel. The next is employee commuting. Again, this is associated with employees coming to and from work. There's been a lot of, since the COVID pandemic, there's been a lot of remote work, and that also, telecommuting, should be accounted for in scope 3 employee commuting. The next, leased assets, shows up both upstream and downstream as well. And so upstream leased assets would be, an example would be a company leasing a office building or an office site, an office space from another company. And so those emissions, depending again on the boundary you set, would either fall under scope 1 and 2 or could fall under scope 3 leased assets. On the flip side of that, if I'm a company that owns equipment or a building and I'm leasing that out to my tenants, the activities from me leasing those assets out would fall under downstream leased assets. Processing and use of sold products. Processing is not very common, but it's if you sell something that then emissions, it's not a complete product. And so something needs to happen to it before it becomes a complete product. That's where category 10, processing of sold products, would show up. A very big one is category 11, use of sold products. And so if I sell a product that requires the use of fuel or energy or is going to use emissions to be used, I would account for those emissions under category 11, use of sold products. And we'll dive into that one a little bit deeper in a few slides. The last one here is, or not last one, but end of life treatment of sold products, similar to waste, but it's after I sell a product, what does its end of life look like? Do I have a take back program? Is it going to find its way into a landfill? Is there any sort of recycling that will occur? All of that needs to be accounted for and understood and shows up in this category. And then category 14 is franchises. Not super common, but if you operate under a franchise model, similar somewhat to leased assets, downstream leased assets, is the emissions associated with the operation of those franchises would show up in category 14. And the final one, category 15, is investments. And so companies that are investing into another company, the emissions associated with that investment would show up in category 15. I know that was quite a bit of words, but that covers all of scope 3. And as you can see from the 15 different categories, it is wide ranging from all the way up your value chain to all the way to the end of life. And that is why scope 3 emissions make up so much of a company's inventory. So in the built environment, there are a few highly impactful categories. Those, as we talked about, purchase goods and services, capital goods, transportation distribution, both up and downstream, use of sold products, and end-of-life treatment of sold products. And so I want to dive into those a little bit deeper. So as we talked about purchase goods and services, I'm personally a visual person, so I like images. And so a few on the slide here, things like steel coil, lumber, chemicals, that would fall under purchase goods and services. And again, it's the embodied carbon, the carbon that it took to produce these materials. Much greater depth we'll go into on this and on the later module, life cycle assessments. But capital goods, so things like forklifts or an entire industrial production system, if those are capitalized, again, capital goods category is applicable, but thinking about the carbon, the embodied carbon that it took to create these things. And purchase goods and services is a very wide-ranging category. And so things like a laptop, office supplies, coffee, snacks, water bottles, etc., those would also all show up in purchase goods and services. And so you can think of that, it's almost a catch-all category, to where many, many things fit into that category and fall under that category one. Two other categories that are highly impactful in the built environment are transportation distribution, again, both up and downstream. And so this one's somewhat self-explanatory in that it's the movement of goods. And so whether you're using 18-wheelers, box trucks, again, the emissions associated with getting those products to you and then moving those products from your operations to your customers, all of that is captured in scope 3 transportation distribution. I have trucks on this one because that's the most commonly used, but there's also, this can show up as airplane, cargo planes, and shipping containers as well. So all of those categories can fall under this transportation and distribution category. Then a few more here in the built environment are use of sold products and end-of-life treatment of sold products. So if you sell a product that uses or consumes some sort of energy or fuel over its lifetime, you are, per the GHG protocol and ISO standards, you are to account for the emissions from the lifetime of that product in the year of sale in your scope 3 emissions use of sold products category. And so a few examples here are an HVAC unit, electric doors, a laptop, all of that consumes some sort of fuel or energy. And again, it is the role of the company that produces that to account for those emissions. And then end-of-life treatment of sold products. Again, talking about where do your products end up at end of life? Do they end up in a landfill? Do you have a take-back program? Are they recycled? All of that needs to be accounted for, but highly understood as well, so that you can most accurately account for the emissions associated with the end of life of your product. So now that we talked about the different categories, the different scopes of emissions, I want to get into how to calculate greenhouse gas emissions. This is a very simple slide, and conceptually, calculating greenhouse gas emissions is pretty simple. It's activity data times an emission factor equals greenhouse gas emissions. Can it be that simple? Yes, but usually no, to be honest. In practice, greenhouse gas emissions are not this simple to calculate. And so we want to get into a few portions of this equation, the variables of activity data and emission factors, and show where that data comes from, what it looks like, where to find it, and talk about how to calculate greenhouse gas emissions. So what data is needed for calculations? Again, talking about activity data, this is information that shows how much of an activity is happening that causes emissions. So again, scope 1, Fuel and fugitive and process emissions. Scope 2, electricity, heat and steam. Scope 3, a few examples are materials and products, logistics, waste, employees, and business travel. Examples of this data, going back to scope 1, fuel, diesel, this could be gallons, refrigerants, the weight of recharged refrigerants, electricity, this could be in kilowatt hours, megawatt hours. For materials, weight is a very good activity data point. Business travel, miles, logistics, miles, and weight. I will say that these examples are good, really good data points. A lot of companies, especially in their first year of conducting a greenhouse gas inventory, will not be able to get primary activity data. And when I say primary, again, I'm thinking of gallons, weight, kilowatt hours, miles, etc. A lot of times, a few of your categories will be either need to be estimated or will come via spend. And so that's perfectly fine. There are emission factors out there that allow you to take how much you spent on commercial air travel in a given year and calculate the associated greenhouse gas emissions. And so over time, as you conduct more and more greenhouse gas inventories, typically on an annual basis, you want to shift up in your categories from, if you're estimating based on a square footage intensity value, or if you're calculating based on spend, you want to be able to elevate and level up over time to the next best data point. And so if you're on spend for your materials, you want to figure out how to get up to weight so that you can more accurately account for those emissions. And then moving from there, it's not only just weight at a material level, it's weight at a material level and then adding in the supplier specific emissions. And that's how you move up over time in data quality for greenhouse gas emissions. Where does this data exist? In a whole host of different places. So operations, fleet, human resources, the accounting team is very important just because, again, some of this data is sitting on spend and they're the people who are going to have that data. And then procurement as well. But overall, activity data, while it sounds simple, this is one of the biggest hurdles to get over in carbon accounting is figuring out not only what data do I need, but how do I capture all the necessary data? And so activity data and getting the right people involved is highly crucial for conducting a successful greenhouse gas inventory. So the next part of the equation is emission factors. So emission factors are just a value that estimates how much greenhouse gas is released per unit of activity. A few examples include carbon dioxide equivalent per gallon of fuel, CO2e per kilowatt hour, CO2e per ton of waste. These are typically broken out, again, going back to the Kyoto Protocol, into different greenhouse gases. And so you'll have a CO2 emission factor, a methane emission factor, and a nitrous oxide emission factor. And all of that will roll up into a CO2e value. And then wanted to provide a few examples of US emission factor databases. So the EPA GHG Emission Factor Hub, the EPA eGrid, Emissions and Generation Resource Integrated Database, EPA's Environmentally Extended Input-Output, EEIO models, those are for spend. And so they have mapped out by NAICS codes, spend-based emission factors. Oregon National Laboratories GREET model, NREL's emission factors, and then CARB, California Air Resources Board emission factors. And I know, so all of these databases are updated somewhat. EPA Emissions Factor Hub, eGrid are on an annual basis, EEIO every few years. And so these are just, again, some examples of where to find emission factors. So really wanted to drive home the point of why Scope 3 is so important. This is an image from CDP and shows Scope 1, 2, and 3 emissions by sector. And the orangish yellow color is Scope 3 emissions. And as you can see, it makes up the vast majority of this graph. Again, typically 80 to 90% of a company's emissions will fall into Scope 3. And again, this is why it gets so much play in the news cycle and why everyone is heavily focused on calculating Scope 3 emissions. So now that I've accounted for my greenhouse gas emissions, what do I report? And reporting depends on a few things. It's really who you're reporting to and the mechanism you're using, which depends on your company's size, sector, the scale of your operations, especially when it comes to energy use and carbon emissions. And so the next question from not only what do I report, but where and how should a company report its carbon emissions and reductions plans? And so within the US, there are regulatory and marketplace reporting. And we like to think of this as kind of a stick versus a carrot. So the stick is your regulatory side where it's mandatory. And then the carrot is your marketplace examples, things like CDP, SBT, which CDP, formerly the Carbon Disclosure Project, Science-Based Target Initiative, SBTI, Walmart's Project Gigaton, and then just voluntarily reporting into a corporate sustainability report. We like to think of these more as carrots because companies are requested very commonly to report to these. And so it feels like a mandatory request, but it's basically saying in the example of Walmart of, as you report through us and do better, we will give you more. You will keep you on our shelves, basically, and we'll have better contracts in the future. And so the carrot is you get to maintain a relationship with potentially one of your key clients. But the regulatory examples, a few we have shown here: California, Illinois, New York, Colorado, New Jersey. We want to dive a little deeper into those and also the marketplace examples. So California, SB 253. This is a rule that any company doing business in California and having over $1 billion in annual revenue is required to report, and they're required to report Scope 1, 2, and 3 emissions. And they cite the GHG protocol corporate standard and the value chain Scope 3 standard in the law as kind of the methodology to follow. And then California considers you to be doing business if you meet any of the following: engage in any transaction for the purpose of financial gain within California, or organized or commercially domiciled in California, and your California sales, property, or payroll exceed the following amounts. So they're not very high thresholds for what California considers to be doing business in the state, and this law has been passed. A few others that we talked about: state of Illinois, HB 4268, that's corporate Scope 1, 2, and 3 reporting. New York, again, Scope 1, 2, and 3 reporting. Colorado, Scope 1 and 2 reporting by 2028 and Scope 3 reporting by 2029. And then New Jersey introduced just this year. That would be for Scope 1 and 2 reporting 4 years after enactment, and Scope 3 reporting 5 years after enactment. And so these are all still proposed, but there is a decent likelihood that they would get approved. And so companies need to be very aware of the regulatory landscape in which they sit and making sure they are compliant, especially concerning greenhouse gas emissions, and conducting a transparent, accurate, complete, relevant greenhouse gas inventory is the first step in mitigating these compliance risks. The other one here is kind of that marketplace that we talked about. So some examples, again, are CDP, SBTI, and Walmart Project Gigaton. So CDP is a global nonprofit that operates an independent environmental disclosure system. They cover a lot. They used to be called the Carbon Disclosure Project, but they have expanded their scope to include a lot of other things. Things like governance, risk and opportunity assessment, business strategy, targets, performance and reduction initiatives, carbon pricing engagement, but it does also include still greenhouse gas emissions data and intensities, your methodology, and GHG verification if applicable, but they do give extra points as if you do verify your GHG inventory. SBTI, this is one that'll be covered in a later module, but is a corporate climate action organization that enables companies to set science-based reduction targets. And then Walmart Project Gigaton is, again, Walmart's take on reducing their scope 3 emissions. They realize that most of their emissions exist in their supply chains, and so started Project Gigaton in 2017 with the goal to reduce 1 billion metric tons of greenhouse gas by 2030. They actually achieved this in 2023. And so good for them, but suppliers are incentivized, again, through contracts, reporting compliance to set science-based and measurable action to reduce emissions across energy use, nature, waste, packaging, transportation, and product use and design. Others do this, other companies like Amazon and Microsoft. So I think Project Gigaton makes the most headlines, but there are others doing this as well. So kind of getting towards the end here. So it's important to understand, why do companies report? And so the concept of a stakeholder and stakeholder expectations is crucial. And so stakeholders are individuals and entities that can impact or are impacted by a company. Some of the big ones here, governments. Again, as we just went through, they're setting regulations so that companies report. Investors are using ESG criteria to guide investment decisions, and a lot of them are requiring companies to disclose their greenhouse gas emissions. Suppliers and customers, again, the Microsofts, the Walmarts of the world are demanding that their suppliers, or requesting that their suppliers report and take action on their greenhouse gas emissions. And then consumers are starting to shift their spending towards more sustainable products. Communities are also increasingly engaged and placing extra scrutiny on the environmental impacts of companies in their communities. And so that is a key stakeholder that sometimes gets forgotten or overlooked. And the last one is employees, especially kind of generationally, like millennials and Gen Z expect employees to share their values and act on environmental issues. And so this is just a brief overview of kind of some of these stakeholders and what's driving carbon and greenhouse gas reporting for companies. So now that we've gone through, again, where to report, how to calculate. So what do you do after reporting? So key things is establish a baseline from your first greenhouse gas inventory. And through that, you can identify key emission sources or hotspots. From there, you can set reduction targets and then develop and implement reduction strategies. Again, a lot of the reduction targets and strategies will be covered in the science-based targets module. But the hotspotting is something that shows up after conducting an inventory. So I did have one fun story. We conducted an inventory for an oil and gas company. And when presenting the results, the CEO asked if shifting to organic snacks in their break room would move the needle on their greenhouse gas emissions. And they had a significant number of metric tons of carbon dioxide equivalent. And so what hotspotting does, and so I tell that because we had to explain to him that you're an oil and gas company, and that shifting to organic snacks in your snack room would not really show up. We were happy to calculate it the next year, but it was not going to move the needle on his overall emissions. And so what hotspotting does is allows you to identify key categories that are highly impactful, and that's where you start. And so if purchase goods and services, that's the PG&S, are your biggest emission source, that's where you start. If electricity makes up 2% of your overall inventory, it doesn't, yes, there is merit in going after that, but overall it won't move the needle for your company and your overall emissions impact. Some things that are common strategies that show up for reduction are like electrification, shifting away from fossil fuels, the use of renewable energy, finding lower carbon materials, which really focuses on supply chain engagement. And again, will be covered in the life cycle assessment module coming up. But overall, this is after you establish that baseline and report, this is your next best steps is hotspotting, setting reduction targets, and developing and implementing reduction strategies. So kind of summarizing all of this is carbon reporting. Again, there's a few different names you can use, is about more than just reporting. It allows a company to, again, identify hotspots and emissions reduction opportunities, which can lead to cost savings, mitigate compliance risks, improve corporate reputation, meet and or exceed stakeholder requests, and helps companies increase competitive advantage and potentially identify new market segments. And so again, everyone gets this carbon tunnel vision, but there is a lot that can be done after reporting once you have a good baseline and have established a good greenhouse gas inventory. And so with that, I've kind of come to the end. I don't believe I saw any questions in the chat, but does anyone, I'll come back on video here. Does anyone have any questions about what we covered today?
I have a quick question, if it's all right with you, Robert.
Yes.
I was just wondering, I mean, obviously, our audience within the supply chain school range widely in terms of their size of business. So we've got the small mom and pops, and we've also got the multinational corporations. Would you say there's a difference in terms of tackling carbon reporting for a small business versus a very large business in terms of barriers to getting going?
I would say yes. Yes, there are. And that large companies, like significantly large companies, they potentially have a whole sustainability team. And so they have a lot more resources to go figure out, again, activity data and data collection is one of the biggest hurdles to get over. And so they have teams of people who can help. But for kind of the smaller mom and pop shops that sometimes they have a team of one, maybe a team of two, or someone just got handed sustainability. We've seen general counsel get handed the topic of sustainability, or an environmental manager get handed sustainability. And so you still take the same steps of, again, setting the boundaries, but there is a larger hurdle in understanding and being able to have the resources to go out and capture all of that data.
Yeah, okay, great. Just in case anyone has questions after the fact, I will highlight that again that the slides and recording will be circulated to attendees once we wrap. So feel free to respond via email. Robert's kindly provided his contact information on the slide, so feel free to get in touch with him directly. Robert, was there anything you wanted to add before we close out?
I don't, not too much. I know one topic that has been always gets tossed around right now, especially this year, is kind of where all this is going under kind of the new administration. But nobody really knows, to be honest. And so we're all in a wait and see. But there are, I know, a few team members have shared with me a few facts with prior to this administration's previous time in office. Subnational actors had never signed on to the Paris Climate Agreement. But by the end, again, of the previous time in office, 17 states had officially signed on, 407 mayors had signed on, and overall, 65% of the US population and 68% of the economy was represented by subnational actors who had pledged their alignment with the Paris Climate Accord. So yes, there is a lot happening all over the world in this space, but we do anticipate sustainability, specifically carbon accounting, this all will continue to progress.
Yeah, because at the end of the day, if you don't measure it, you can't manage it. So that's great.
That's exactly right.
Okay, conscious of time, so I think we'll end it there. Like I said, if anyone has any questions in the future, if anything pops into your head, get in touch. We'd be happy to support. I'll be in touch with you all shortly after this session with your slides and recording. And I just want to thank Robert again for being here and presenting. It's a fascinating topic, and I think that was a really great session. I hope everyone enjoyed it. And we hope to see you at the next session. So thanks very much, everyone.
No, thank you, everybody. And as Wendy said, reach out if you have additional questions. This was a lot of information. So if something comes up in your head later, hopefully you're not dreaming and or having nightmares about carbon accounting and reporting. But on the off chance that happens, feel free to reach out.
All right. Thanks, everyone. Have a great rest of the day.